Drew, Meredith, how are you going?
Very, very well.
It's good.
Winter's hit.
Winter's not quite hit, but you never know. You never know, mate.
The chill's starting to come in the morning for sure.
Yes. There's a definite draft. Other than weather, it's a good chance today to ask you a few questions. We've had quite a few questions sent in. Things like investing via an SMSF versus using a traditional super fund, high growth options.
Where do we draw the line between questions and comments as well?
I feel like there is no line.
Yeah.
I feel like it's very blurry here on the Australian Investors Podcast. But I have one question for you, which I'll get to in just a second. This episode is pre-recorded on the Australian Investors Podcast, just as an FYI. So if we do mix some of the numbers up, by the time you listen to this, then you'll know why it's wrong. Other than just us being wrong.
Why is it pre-recorded?
Well, we cannot reveal the secrets of the universe, Drew, here on the show. But no, we are pre-recording this episode as there may be some travel and some family time that's much needed. So for me in particular, because I didn't get much of a break over Chrissy, so that's why we're doing it today. My first question to you, and I'll answer this as well, is what's been your best investment of all time and what did you learn?
It would have to be my education.
Oh, get out of here. You can't say family or education.
Oh, you didn't preempt that. I mean, to be honest, and most people will know this, you end up learning far more on the job than you do we place so much pressure on getting to university and you end up like back in my day. Can I say that? Yes. Yeah, I think I'm old enough to say that. It was 13 contact hours a week for a bachelor's degree, basically. I think hopefully it's changed a little bit since then. But you actually learn, and you would have seen it, you learn so much more in the different jobs, the different roles you take, and the different roles within the jobs that you have. But my best investment, I've got my portfolio live here because I hold on to my winners probably for a little bit too long. So I can tell you with like blow by blow what's done the best.
Give us the top three then.
The top three. There's a few that I've sold in the past. Zip was one.
Have you sold that?
I hold it again, and yes, I'd probably technically lost the money.
You've told us this on the show before.
I missed Afterpay, but I did own some of Zip when it went from about. I made money from about maybe $2 to $10, and then lost money from 10 to 2 in a separate. One was in super, one was outside of super, but. The top ones have, interestingly, like the longer term winners have basically all been global equities. My ability to invest into Australian shares is clearly, and giving context to this, I hold a lot of mid and small caps directly, and then have a big core of active or ETFs. So this is kind of similar to the everything portfolio. That my global equities and my fund and my core exposure have smashed my direct shareholdings. But the winner, and I think it's only in probably the last 12 months, is Palo Alto Networks.
Really?
Probably the best investment I've had. And I reckon that's up 4 or 5 times the original investment. And this was purchased, I think I listened to a podcast probably in
Classic.
2020.
Never listen to podcasts. There's your first mistake.
Podcast. Not financial advice.
Don't do it, Adrian.
Like a US podcast, and they were talking about some companies, and I heard it. I had no idea what it did. I still don't know what it does. Did some research, found some research reports, had a look at a lot more detail, ended up buying shares in Palo Alto, which I believe is very focused on cybersecurity. and like securing networks of big enterprises and the government and the Pentagon and all these sort of businesses. But I'm not sure what the chart looks like on that.
It's good.
Good.
At the time of recording, it's up 530% in 5 years. It's a $121 billion US company.
Yeah.
That's huge.
I mean, that's like 5-fold in 3 years.
Yeah.
The second would be, and I thought this would have been the winner, and I've talked about this when we did the roadshow, which feels like forever ago now. I feel like we need to get the band back together.
Yeah.
Was the trade desk. So similar story, and probably more relevant than ever now. So the trade desk did, from my understanding, again, I find ideas, I research, I buy and hold for these type of companies. And Trade Desk is programmatic advertising.
Yep.
So the ability to say someone who watches Bridgerton on Netflix between the ages of 40 and 60, 40 and 50, and likes striped shirts. You can advertise directly to that person. Maybe you can't advertise to the striped shirt part, but you can advertise very clearly to that person.
Yep.
That would be and then you can see there's two basically global tech companies in some way involved in automation or you could probably say somewhat involved in AI, but that were both bought, I think, 2019, 2020.
That's interesting. That was going to be my question because since then we've seen a lot of the Australian dollar falling against the US dollar. So that just boosts those US results again.
Yeah.
So it's interesting because like it would have been about $20 back then to 66 now. Recently had a massive sell-off, Drew, like from 120 to $60. Yeah. So it got absolutely smoked.
Which was that?
That's Trade Desk.
Oh, yeah.
Yeah, so I don't know how up to date you are, but in the last couple of months, it's been absolutely hammered. Just so you're aware. Sorry to fill you in on that.
When did that happen?
That's fine though.
This is
I sold
pricing.
Trade Desk. I sold Trade Desk in COVID
105
at about $16, and it's now $67.
That's in US dollars. What's Australian dollars?
That'd be even better. But the worst thing again is I remember reading Motley Fool articles.
That's a live price.
I remember reading Motley Fool articles from 2016, 2017 when it was $5 a share, and I was like, Google's going to eat this thing for breakfast. Then it went up during COVID. What did it get to? $107.
Yeah.
So it would have been a 25x.
Yeah, I think this is.
But I sold.
So it's actually fallen, but because of the currency, it's still my second best performer.
Yeah, there you go. The power of the currency.
Yeah.
And what was your third one then? If you got Palo Alto, Trade Desk.
This is actually a fund that I've invested in since inception, which is the Munro. So Nick Griffin, Munro Global Growth Fund, has just been sitting there ticking along, pumping out distributions. Yeah. So there's a pretty heavy tech theme in those.
I can't see your screen right now, but what software are you using to track your portfolio over there?
This is just plugging straight into Hub24. So the superannuation platform.
Yep.
Where I have my SMSF held through Hub24.
Yeah, right. But you need to be an advisor to use that, right?
Generally, you have to be start with an advisor, and you can operate it yourself. Yep. But most of the time, it's limited to wholesale or via advisors.
Yep.
Not being able to invest direct.
Yeah, that's fair enough. In terms of individual stocks, definitely, it would be Pro Medicus. I think it's a 36 or 37x for me. Originally bought that in 2017, I think it was, and still hold it today. Sam Huppert. Yep, he's the man. And my lesson learned from that, which I put in the notes here, is he's obviously a wizard. But secondly, I think it's a bit of luck in that you have to buy these companies in order to have them in your portfolio in the first place. Secondly, is if you find one of those businesses that you are able to hold, is to make sure that you hold on.
Yeah.
Because if the thesis is executing, when I say thesis, I mean the reason that you bought something. So for me, the reason that I bought Pro Medicus was I could see it just won the Mayo Clinic back in the day as a client for its medical software, its radiology software. It was rolling out this new billing method, which was pay per use. So the more scans that went through the radiology departments at the hospitals in the US, the more likely it was to earn greater and greater returns on capital. But that could have easily reversed, right? And so that was the broad thesis. I think this is going to be a really good business in the US. I think it's already gained traction. You could have done the same thing with Afterpay when it announced its expansion into the US and it got Kim K over the line and the Kardashians endorsed its product. I think it's a big lesson in that if you find one of these Australian tech businesses that gets traction in an overseas market, pay really close attention.
Yeah.
Not just fake traction, like say like an acquisition. Like I think Zip did a lot of acquisitions overseas versus Afterpay, which didn't do acquisitions as much anyway. So pay attention to that. In terms of other performers,
don't be afraid to let it, like if there's a lesson you can get from that is like I actually didn't know that the stock had fallen 40% 2 weeks ago.
Oh, there you go.
Like I'm a long-term holder of that company, and even at 40%, it's still a 6-bagger on what I originally paid for it.
Yeah.
So it was actually a 10-bagger. Maybe pay a little bit more attention than that.
Yeah.
It's been a busy 3 weeks, and I wasn't watching reporting season that much. But it is like let your winners run to a point.
Yep.
Not to the point that they're, determining what your retirement or what your lifestyle looks like. But, it's still only, 10% of my portfolio of that direct share portfolio. So I'm pretty comfortable with it.
Yeah, fair enough. That's good. It's good that you do the position sizing. I think the next, all the US names would be up there. Facebook, Apple, they're all multi-baggers. Google, they're all big multi-baggers for me. I made a lot of money on ING, the bank.
ING Group.
Yeah.
That's a value pick.
Yeah, it was back in the day.
Shout out to Nathan.
Shout out to Wayne Peters and Nathan Bell. Made good money out of that over time. So what's it now? It's $18. Back in the day when I was looking at it, it was like $5 or $6 or $7. So that was a good value pick. But I didn't do that for members or anything. I think the other really good businesses that I've owned through time are RPM Global. That's done really well for me, which is the Australian Mining Services Company. We've had a lot of questions on that recently. I think the final few that I'll mention are Altium, which 4 or 5x for me. What else? Net Wealth, all really big winners.
That's one you kind of we worked with Net Wealth in their early days and never bought stock in it. Stupidly.
Wow.
But that's a true winner.
Yeah, these are all really good software, scalable businesses. If I look back on the list of companies that we've recommended over the years to our members, Apple, Pro Medicus, Xero would have to be up there. Xero.
You don't make this sort of winning list by holding
Facebook, VanEck, Moat ETF.
Wesfarmers, great company, but you're not making a 700% return.
Yeah, not in 5 years, but maybe over 20.
Yeah.
Pushpay Holdings back in the day. So many good businesses. Catapult, these types of businesses. Some dogs in there as well, like Dubba. We own Salesforce. Yeah, so there's a lot of good tech companies, and obviously I've got a affinity for them given my background, but I think that there's still a lot of money to be made in those really hyper-scaling type businesses. But we do have a lot of questions to get through here, Drew, today. We've got a few plays on some people's names. Remember, everyone that's watching and listening, is that we don't know your needs, goals, or objectives, so be sure to speak to a licensed and trusted financial planner before you act on the information you hear in a Rask podcast. If you don't know what your needs, goals, or objectives are, please be sure to speak to a financial planner because we can only give general financial advice on these podcasts. There is a link in your podcast player or on YouTube in the description to get financial advice. The first question comes from GPen, and it's more of a broad one. They actually sent the question twice. So I don't know how that happened, but they sent it in 2 different ways, which was SMSF to invest in ETFs, like index ETFs, versus the super fund's high growth option. So they're basically saying, Drew, what's better, do you think? Using a self-managed super fund to do your own investments, or just going with the high growth option that you might get in a industry fund like Australian Super or something like that?
It's a great question, a question that comes up all the time. And I think the episode of the retirement podcast we filmed with Beck Wilson probably is out by now, if it isn't listed into it. But one big thing that Beck talked about was personal choice, and this is a question of personal choice. So you could essentially replicate what you have, very closely replicate what you have in an industry fund in an SMSF if you wanted to. And what I've learned over 20 years is that there's a different solution suited to everyone, and there's so many options that you don't have to be. Not an SMSF isn't suited to everyone with over $1 million. An industry fund isn't suited with everyone under $1 million. There's no fixed rule. It's about what you feel comfortable with. But yes, you should actually add a platform into the middle of this as well.
So something that's not an SMSF, but something that's not an industry fund, it's somewhere in between.
You can add. There's 3 types of super funds. The third one is a platform, something like Hub24, BT, AMP. We've probably heard these names before, but basically you can replicate most of these investment strategies through 3 different wrappers and still be within the superannuation environment. And most of the time, this comes down to what your priority and what your objective is. So do you want transparency and some level of control? Then yes, you could manage that asset allocation yourself. And you can see, in what I find for people in retirement is that they want to know what's driving their returns or what's driving their income, or at least have a little bit of idea. And that's very difficult in an industry fund environment where it's very aggregated, not to the client level. So Yes, I think you can. They're just as competitive as each other. I wouldn't say one's better than the other. I think it's all about finding one that's suited is suited to you and you're most comfortable with more than anything.
Okay, so yeah, and then there's the other, like within the industry funds, like you said, it's just all in the superannuation wrapper, which is more tax effective. But there's member direct options inside the super funds.
And you could create an SMSF and someone did this online, I'm pretty sure, that you could buy Vanguard and iShares products within SMSF and your total fee could be like 0.2%.
Yeah, right.
And the same cost in an industry, like in most high growth options, would probably be like 0.4, 0.5%. Obviously, there could be some other investments in there, but you can very competitively use every superannuation option.
Yeah. I like it, yeah. So Chamath.
Not my thing.
Not my thing. I think this is a play on
Is this the guy who created SPACs?
I don't know how to pronounce. Yeah, the guy that created SPACs, special purpose acquisition vehicles. Palitaya. I don't know how to pronounce his name. I'm very sorry about that. But he was the one that had a few lucky investments, speaking of, like myself. And he said, one of the famous tweets that he had was, I'm in the arena trying stuff. Some will work, some won't, but always learning. You're anonymous and afraid of your own shadow. That was his tweet. But then someone, Eric Newcomer, took that phrase and then turned it into the scam in the arena. Chamath took retail investors for a ride, got away with it, and just can't let himself take the win. So anyway, there's that. But this is a play on words. It's got nothing to do with me.
You're really on the zeitgeist.
On the defensive side, dark side of your portfolio, you have cash in a high interest savings account, a term deposit or two, a bit in bonds. But then what? Are there any decent defensive alternative ETFs? So you got some cash, savings account, term deposits, a bit of bonds. Are there any decent defensive alternative ETFs? Gold could go in there.
Yeah, you've already seen me put my notes in there,
yes.
Live notes. I think the one thing to clarify here is, what do you consider a defensive alternative when it comes to an ETF? So we think of basically a pool of alternatives now. If I'm thinking about a defensive alternative, it's probably going to be less volatile, so less up and down than investing into equities, and probably more than bonds. That's the first thing. So where do you find investments that have less volatility? The thing about alternatives is that most of them aren't conducive. They require a long-term approach and a long-term investment, so most aren't conducive to an exchange-traded fund structure. So naturally, where we've tended to go in the future is gold, as you said.
Yep.
Some people would say it's a growth alternative because it shows volatility. Yeah. It's currency, US dollars.
Doesn't pay income.
Yeah, for sure. And then there's what I'd say is that once you go past government bonds and high grade, so AAA, AA companies, Woolworths, all these, maybe Woolworths, credit becomes an alternative. So credit, it's an income alternative versus a growth alternative, meaning that the most of the returns are going to come from the interest you get on it. And credit is basically referring to this idea of investing into companies that aren't as highly rated.
Yep.
But we were briefly talking about this off air. When it comes to credit, it's all about knowing what you own and making sure what you own is consistent with the purpose of that investment within your portfolio. So credit is just another form of lending, and you're just moving further down the capital structure, or you're investing in riskier companies.
So you got like savings accounts at like a government guaranteed bank and term deposits. Then you step into government bonds, which are like the highest rated ones. Would probably be like the most popular ones are like IAF and
VBND, global bonds, VIF, Australian government bonds,
VAF. These types of just vanilla ones, and then you can go from that into start to trickle down into what's credit, which tend to be floating rate in nature, not so much fixed rates. But then there's also those other things that are like not necessarily ETFs for this person, Chamath. They're also other things like funds, funds and LICs and trusts that are on the ASX, like REITs. There's credit. There's real estate.
Private
funds.
Equity probably gets a bit too growthy.
Yeah.
There'd be there's hedge funds that have low volatility or manageable volatility.
Yeah.
There's inverse. You could say a defensive alternative could be something that's inverse to markets.
Yeah.
Potentially.
Yes. Yes. Well, you got BBOS, right?
Like a BBOS. That's for another episode.
Permanent.
But you want something that's not going to blow up.
Yeah.
When the share market falls, and you'd be able to sell it, or you'd be able to continue to generate income from.
Have you ever invested in CTAs?
Winton. will be one example. Yeah.
Yeah.
I think the hard part of, and we continue to, is with something like a CTA, so commodity trading advisor, essentially.
Yep.
Where they're actively trading options and trying to see
futures,
very short-term trends, basically. Is that they don't work and then they work, and you have to be comfortable getting like 0% returns for 4 years to be ready when a crisis happens and they work. And it can be difficult for individual investors to accept a 0% return when everything else is doing well. For the idea, it's insurance basically, that when everything goes wrong, it'll pay off. So you may never see it pay off.
So for people that aren't keeping up with this here, a CTA, commodity trading advisory, is like a special type of hedge fund that uses all of the tools available to it. So things like options trading, futures, multi-assets. So it can basically do anything is what it is. In my experience, Drew, you don't need them.
They're expensive.
Yeah, if you just put money in cash if you're that worried.
Depends on the person, It can, when cash rates were low, it was more, you were kind of more encouraged to use these kind of things because you weren't losing anything, but with cash rates at 4%.
Yes, put it in a government guaranteed term deposit. But I would say, so a bit of gold. I recently spoke with PIMCO, Kinish from PIMCO, and they've just brought out their active range of ETFs. The sponsor of a retirement podcast, just
it's a massive trend as well.
Yeah, and that's fine. I think that some active management in bonds is it's actually pretty reasonable. So I would actually look at something like that and just look at things like the yield to maturity and the income that you're going to get from it through time. So we've got time for 2 more quick questions here. Sure, if required. I don't know what that was in terms of the question name, but what's the smartest way to invest? That's a bloody good question. We're trying to figure that out for 20 years. I'm beginning my investment journey and I have $4,000 this year to invest in A200 and IVV. Would you recommend, obviously we don't recommend, putting a lump sum of $1,000 into each ETF and dollar cost average the remaining $1,000 for each fund each month? Or dollar cost averaging from the very start and not put in a lump sum? So this is about market timing, this question. And they just say, I'm mindful that if I put the full sum in straight up, it might
$400,000
be a while the market is high. It might be a while because the market is high, whereas if I spread it out throughout the year, it might be more cost effective. Now, obviously, we can't answer this with specificity and we don't necessarily make recommendations on the show. You need to see a financial advisor for that. But there is a famous Charles Schwab study, which I'm happy to link in the show notes. I think BetaShares did it for the Australian market, Charles Schwab. I'll just pop that in the show notes before I forget. And what they found was they ran an analysis on 5 different types of investors. And each investor had $2,000 a year to invest from 1993 to 2012. I think they then extended it to 2022. And what they found is they ran 5 different scenarios where someone just buys into the stock market on the very first day of the year, so January 1st. Another one where they buy on the lowest day of the year, so that would be the world's best timing. One where you got the world's worst timing, where you buy on the top of the market. Another one where they did dollar cost averaging, and another one where they just stayed in cash. And what they found was, and I've talked about this on YouTube at least a dozen times, is the person who had the best timing, which is impossible for 20, 30 years in a row, got the best results. Yeah. But the person who dollar cost averaged and the person who invested straight away achieved about 90% of the result that the best timing got.
There's no difference,
There's no material difference. The key thing is to just stay invested.
Yeah. Not
so much when you invest or how you invest, but just to stay invested. And that has always been my takeaway from these types of things, particularly when you're buying, the US S&P 500 or the top 200 in the A200 ETF for Australia. So that's kind of my take, Drew, is just don't worry about the timing as much. Obviously, if we're talking about $100 million and it's your life savings and
$100 million,
I don't know, just even $1 million, like you would obviously then have a bit more flexibility in what you could invest in.
More diverse range of assets. Yeah, so usually if you were buying 10 ETFs,
they've got 2 ETFs in this scenario.
You're buying bonds, I just go put it all in. Yeah. If you're buying a diversified portfolio, you're buying 2
growth
index and they're market cap weighted, so you're getting a lot in like 10 companies basically.
Yep.
And this isn't about the maths. This is about the emotion. My advice would generally be, if it's new to investing, would be to at least split it into 2, like one now, one, and not next month, one 6 months from now.
Yep.
Like a month apart, it's not, I mean, unless you're looking at the market at the moment, that's not going to have an impact. Wait another 6 months and maybe you'll end up buying something else and you get a bit more diversification. But more importantly, you've actually split into a reasonable gap. That means if you have a bad experience with the first investment, you've still got the opportunity to buy in lower later on, and you're not going to be buying in particularly higher, and you're investing for 20 years anyway.
Yep.
But if you put it all in the first week and then the market dropped 10% like it did, in February, there's every chance you go, oh my gosh, I've lost, $400 out of my, nearly down to $3,000. I got to get out. So it's more about the psychological side.
Absolutely it is. Yeah. And that's why I think like a lot of the things that look good in a spreadsheet don't match reality. And for most people, whenever this question's been brought up, and it doesn't matter if it's property or shares or whatever it is that you might be investing in, I think go with what is going to make you feel most comfortable, because oftentimes we see most people make the biggest mistakes in their financial life out of panic or fear, or even greed. And as long as you are finding a framework that works to soothe your emotions, if you have never invested before, start with the smallest possible amount and just see how you go for 2 or 3 months. Like start with $10. Go and open a Raise account or a Sharesies account or a Palo Micro or a Beta Share. I think they do like $10. Just go and just get a feel for investing. You don't need to do it all at once, and just take baby steps and slowly build into it. You got the rest of your life to compound. It's a great question though. So the final question comes from Dizzy Rask Owl, which is the name of the community portfolio, which is looking a little bit sad right now. Dizzy Rask Owl. Hi guys, love the pod.
Just could be looking good by the time.
By the time this is going to air, who knows? It could be a massive reversal. A bit like Kev Tui's pick of KKR. Hey guys, love the pod. Just wondering if you could explain the use of margin lending from your portfolio, speaking of risky, and if it's possible or a good idea to use it to buy a property. That's interesting. Before we get to this, margin lending can be risky. And Kev Tui, love you, mate. But
do you reckon he's getting comments and people following him on LinkedIn now?
Who's Kev Tui?
I bought KKR.
Not at all. But if you do get a chance to follow Kev on LinkedIn, I'm sure it'll be great because it's full of insights.
Good golf game too.
Oh, really?
Yeah.
Okay. We can't talk about golf. Margin lending. So margin lending, what is that? Let's start with that. So margin lending is where you use some money, usually arranged by your broker or your bank, to put money into a share or ETF portfolio, but there is a component. The margin point is that you have to maintain a buffer in that account. Say it's like the actual loan that they give you, say, might only be 80% of the value of the investments. And if the price of your investments falls, but the loan is still at 80%, obviously in actual math, the percentage goes higher, and they'll say you need to top up or we're going to sell now.
Yeah. And
that is why they call it a margin, because you've got this margin that you have to guarantee to the broker or the bank. I think margin loans are pretty horrible, just generally.
Expensive usually.
Yeah, the interest rate's really high.
Control, I think, is the key there.
Become a forced seller.
Yeah.
Yeah.
The preference is always, and we don't have a license to advise. We gave up our license to advise on margin lending. We don't do it. But a lot of people do is use their investment, use the equity in their house to get an investment loan and then invest that into equities, and then they have the flexibility rather than the restrictions that come with margin lending. Yeah,
so margin lending is a particular type of thing. So margin lending is when you do it through your brokerage and your bank, specifically for stocks. There are other ways to get loans to invest, which is like Drew said, where you redraw equity from your house. It's a very different structure. It's very common. In fact, at the time of recording, Drew, I got approval for that yesterday.
Yeah.
So we just did a massive equity release from our house, redraw on the loan, top up the loan, and then you have that money available.
Straight into GGUS.
Straight into 100% leverage stocks. Zip. What'd you say, Zip, on the podcast? That's where we get our tips. But that's in my opinion, you're far better off using a property as for security to invest sensibly, using debt recycling or equity release. But this one is actually doing it in reverse, because they're saying that they're using margin lending from the portfolio to buy a property. That's how I read this. They're doing it in reverse, which would be absolutely wild.
Yeah, that means you're
taking stock market
security.
risk.
Yeah.
against a
leverage into
loan
something, and it would be more
on an
expensive.
asset that's illiquid.
I mean, it could be that they don't have the asset, the property that they could lend against, so they're using equity, and that's the only one thing they have. But it's highly expensive and inefficient. I think most margin
do it the other way around,
above 10%. Yeah.
Well, I don't know their
Sell it, buy a
situation.
property.
Go sell the shares, buy the property, then use the loan against the property to buy the shares. I can't tell you what to do.
Anything margin lending just kind of scares me.
This is risky.
Look at a margin lending interest rate. You could look online. I won't say who it is.
To be up near 10%, surely. And the basic way it has to work for everyone that's playing along at home, if your interest rate say like 10%, 9.9%, if you've effectively got to earn that minus the tax rate, so tax adjusted interest rate, which might be like say 6%, 6.5%, you have to earn that in order for it to make any sense.
Yeah.
And because you're adding volatility, as in you're investing in a risky asset, not only do you have the interest, but you also have to make sure that you've got enough money to top it up. So I think that whole concept of traditional margin lending is risky. It does not align with my values of, say, for example, debt recycling or equity release, which is much more sensible and long-term focused, in my opinion. We don't have a license to actually do margin lending either, and it wasn't something that I was interested in ticking whatsoever on the box when we got the license. This is some great questions here. I think if you've written in a question today, be sure to send us a message on the Rask websites, and we will organize you a free value investor program, which is a $499 course. It's yours for free. Just say, hey, I sent in that question about SMSFs or the one about margin lending. You walked me back from the plank, good sirs.
And a book for Chamath, Not My Thing, I think.
And Chamath, Not My Thing. You get a free book of The Golden Years, How Not to Stuff It Up by Drew Meredith and Jamie Nemsis. No, that's not the subtitle.
I've got a good dad joke for you this week too.
Okay, give it to us.
I've had to adjust this one because I think it understates the answer. Mm-hmm. What do you call a sheep who can sing, dance, and act?
Fluffy?
Lady Barber.
Lady Barber?
Lady Barber.
Oh, gosh. Oh, she's a triple threat. Well, mate, this
I had to act into that joke. I would have underdone it, to be honest.
Well, mate, this has been heaps of fun. Lovely shirt today. Thanks for joining me.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.